why does buying your own stock raise the price of the stock?
Is it just pure demand? Like,
Yeah. Okay. So I call it the buyback process. There's really four stages to it. Okay. A company will announce that it's doing a stock buyback, a big one. Let's say a $10 billion stock buyback. They might say over the next 4 years, or the next 2 years. They might say over an indefinite period of time. That will usually happen at an annual meeting. The board will say, we authorize the CEO, the CFO, at any time they want, on any day they want, to go tell their broker to go into the open market, that is the stock market, and buy back a certain amount of stock. Okay. That then is in place. Now, it's been documented that when companies make that announcement, there tends to be a 2 or 3% bump in the stock price. Now, you could say that the stock market would say, oh, well, that company is shooting itself in the foot, like you said. So there should be a downgrading of their stock because they're giving away money. And who are they giving away to? They're not giving it to shareholders. They're giving it to making advantageous for you to sell their shares, share sellers. If you know when the buyback is being done, you can make money. Now, if I go buy shares, as much as I know about stock buybacks in any company, I have no idea when the buybacks are being done. For one thing, there's a rule from 1982 from the Securities and Exchange Commission, which says that you can buy back a safe harbor. You can buy back a certain amount per day, which can be massive, without being charged with manipulation. But the Securities and Exchange Commission does not know those days. Since 2004, we know the months they did them in retrospect. But if you know when it's being done, and anybody who's a hedge fund knows when they're being done because they're watching the broker through whom they have to do it, they can buy and sell around that buyback. The executives inside know when it's being done. Okay, so but that's how you make the money. Now, the second thing way the stock price goes up is when you actually have the broker go in there and demand the stock. It can have an impact on the stock price just because you said demand. There's an increased demand. Now, it's not a small amount. Apple, under this, it's called Rule 10b-18 from 1982, which we call a license to loot. Apple can do, last time I looked, and it changes depending on trading volume and price, could do $4 or $5 billion a day of buybacks without being charged manipulating the market. Microsoft could do about 700 or 800 million a day, day after day after day, without being charged manipulating the market.
that's
Okay, so
insane.
yeah, so that's what now. Okay, so that's driving the stock price up. Then you're going to, when that happens, there's going to be some people who don't really know that there's a lot of buybacks going on, but they see this momentum on the stock, and they're watching that, Jim Cramer, Mad Money, or some crazy thing, and there's a momentum on the stock, buy the stock, and he's going crazy about this, and so they start speculating on the stock, and it goes up further. Once you give stock momentum, and so the interesting things is that companies buy the stock in the boom when it's expensive. They don't buy it when it's cheap. They buy it when it's expensive to try to keep up with everybody else. Okay, so when Apple's doing 95 billion a year, they can afford it. They have all the profits, but they're raising the bar for everybody else to keep up with them. Okay, that's the third thing. So you get this. So you get the announcement, the actual buyback, the speculation. Then they issue their quarterly reports or their end of year report, and there you can see the impact on earnings per share. Okay, and what shareholders care about is not whether the shares have gone down and earnings have stayed the same, but whether earnings per share have gone up. And they'll then, if earnings per share have gone up, they'll say, hey, the company's doing great. Now, part of this, when you look at the bigger picture, is the other impact of this is that because so much money is going into buybacks. So if you take the S&P 500, we haven't quite updated to 2023 yet, but if you take it we usually look at a decade for the companies that were listed over the whole decade in the S&P 500. So there was something like 476 companies that were listed from 2013 to 2022 for the decade, 10 years. And you look at the amount of buybacks they did, I think it was something like 6.4 trillion, 54% of net income, and another 40 something percent in dividends. Okay, some companies are actually paying it's more than profits because they're eating cash, they're laying off workers, they're selling assets or whatever. Okay, but companies are spending almost all their profits, maybe even more, or even over a long period of time, pumping up their stock price. What that means is that if I go into the stock market now, and I know that if a company like Nvidia, which is hugely profitable, or a company like AMD, which is hugely profitable, and in the past that they didn't do buybacks or even pay dividends, that they're going to do so in the future. And so that they're going to support their stock price. And so when I go in there, it's not simply that I'm going in speculating. I'm going into a company where I know that they now have what is now in every annual report called the free cash flow that is going to be devoted to getting my stock price up if I hold the stock. And then I'm going to think about, okay, when is the best time for me to sell the stock to make money? And it's going to be when these companies are really supporting the stock price, but maybe running out of steam. If you can now, obviously, not everybody knows when they run out of steam, but that 145 billion that Intel CEOs spent before they brought Pat Gelsinger in meant that that company was not going to be able to catch up. They were out of the picture. They turned down the contract for the Apple microprocessors in 2007. Apple gave that to the Koreans and the Taiwanese, and Intel's trying to catch up. They brought in a guy, in this case, who was a production guy. He actually was one of the few CEOs, the only one I know, who took the job, telling the board that he no more buybacks, and he's now just been fired because they haven't been able to turn around the company. No fault of his own.
Hey, if you're doing all these buybacks, how is your earnings per share going up?
Because you're okay. You can have stagnant earnings or even declining earnings, but earnings per share, it's a numerator over denominator. Buybacks take away the denominator.
Oh, so they don't, your shares no longer count against the pool.
That's right. If they're
That
in the
changes everything
treasury,
for me.
it doesn't really matter. They might retire them, might put them in the treasury.
I see, I see, I see, I
Yeah.
see, I see, I see.
Okay, so
Wow, that's really interesting.
this is crazy. This is like where I wanted to get to because I feel like we have just a few minutes left, and I want to be able to put the pin in this conversation so we have a handle to pick it up from next time. Because something clearly happened to the American economy, to maybe even to the global economy, starting in 1970, that is still unfolding today. And I think that this financialization of the stock market and the stock market being representative of how good the economy is doing.
The financialization of firms, it sounds like. The
Of
stock
the
market's
firms.
kind of always been there.
Yeah, absolutely. So it's like, it seems to me that there's something about the financialization of these firms where if the stock market used to be a relatively accurate representation of the profitability and functionality of a firm, these sorts of programs are eroding our ability to actually see what's happening behind the veil because you're able to do financial machinations that artificially inflate your stock price. You're not investing that money into your workers or into your technology.
And investors are operating quite algorithmically, right? When we talked about index funds earlier and